Hi everyone, welcome to SRV Academy of Accounts. Here all my preparations and presentations or exam point of view. Follow my regular classes, get more marks in your semester exam. Subject Income Tax Loan Practice, Chapter Income from Capital Gain, Class 3. Today we are going to see two more important problems in capital gain. Okay, now the first one. First I read the question, listen carefully. Compute the taxable capital gain from the following particulars. Cost of acquisition of the house at Delhi 1996-97 1 lakh. Cost of improvement made 1999 2 lakh 50,000. Fair market value on 1/4/2001 4 lakh 60. Cost of additions made in 2008-2009 3 lakh 20,000. Sale price of the house on 1/11/2022 28 lakh 60,000. Expenses on sale 60,000. It's very simple. And also it's a very important sum. You know why? See here, cost of acquisition and cost of improvement, both the values are given on or 1/4/2001. Assessee is going to choose higher value of any following. 1. The cost of acquisition or fair market value. See here we have small workings. Okay. See, note calculation of cost of acquisition, that means original cost. Acquisition before 1/4/2001 1 lakh. Add improvement before 1/4/2001 50,000, together 1,50,000 total. You compare with fair market value 1/4/2001 4 lakh 60,000, and whichever is higher, the higher we consider as a original value. Okay, original value means that is a cost of acquisition on 1/4/2001. This is the simple. Next, before we work out the answer, and you should classify the given problem is belongs to short term or long term. How we are going to be classified? Simple. So when assets held by an assessee above 36 months, we say long term. The below 36 months, we are going to say short term. Next, write down the heading, a computation of long term capital gain for the previous year 22-23, and divide the three columns, particulars, amount, and start with sale price. The sale price is given how much? 28 lakh 60,000 less selling expenses, 60,000 selling expenses given, and balance we call a net consideration 28 lakhs, followed by and less cost of index. You know the meaning of cost of index? Yes, cost of index is nothing but finding the present value of past investment. So in cost of index, first we are going to find index cost of acquisition. Okay, what is the index cost of acquisition? The cost of acquisition, simply say cost of purchase. Okay, so here as per the working notes, we know the value of cost of acquisition. So the formula, cost of acquisition into CII for the previous year divided by CII for year of purchase. So as per working note 1, 4,60,000 is the cost of acquisition into 331 for previous year CII divided by the base year of 100. So 460 into 331 divided by 100, and just what is the value? 15,22,600. Next, index cost of improvement. See, so before that value, then you know the formula, the cost of improvement into CII for the previous year divided by CII of the year of improvement. So 3,20,000 improvement value is given into 331 divided by the 137. So total 7,73,138. That is the value of cost of improvement. And you find the total, the both index cost of acquisition and index cost of improvement, 22,95,738, and deduct out of net consideration the balance 5,04,262 called as a long term capital gain. Out of long capital gain, less deduction under section 54, either deduction or exemption 54. And here the reinvestment of capital is, any reinvestment is given? No, nothing. So reinvestment in capital asset, so here nil. The same balance, the 5,04,262 we called as a taxable long term capital gain. Now the problem number 2, find out the capital gain income from the followings. Cost of acquisition of the house at Delhi 1997-98 1,85,000. Cost of improvement made in 99 2,000 40,000. and fair market value on 1/4/2001 1,75,000, cost of additions made 2004-2005 60,000, sale price of the house on 31/1/2000, sale price of the house on 31/1/2023 8,60,000, expenses on sale 10,000, and advance money forfeited and retained on 1/8/2013 25,000 is given. So with help of these details, you have to find the long-term capital gain. You have to find the capital gain. So I said earlier how we are going to classify these sums belong to short-term, long-term, and simply say then assets held by an assessee above 36 months or not. Here, when it was purchased 97-98, and when the property is going to sold out in the year of what about 2023. So about 3 years, that means 36 months. So we take it as a long term. Any advance money forfeited and retained on or before 1/4/2014, the value is going to deduct out of cost of acquisition. Advance money forfeited and received after 1/4/2014, the value directly you take into the income from other sources. Okay. Here advance money before 1/4/2014 or after 1/4/2014? Before. So the value of 25,000 we are going to deduct out of cost of acquisition. Okay. I'll explain in details with workings. Now see. Note 1. So cost of acquisition. Assets acquired before 1/4/2001 how much? 1,85,000. Improvement made before 1/4/2001 40. Total 2,25,000, and the fair market value on 1/4/2001 1,75,000, and whichever is higher 2,25,000 be treated as a cost of acquisition. That is number 1. Go to the working note number 2, the net cost of acquisition. The net cost of acquisition is nothing but cost of acquisition minus advance money forfeited. So already I told any advance money received on or before 1/4/2014. Here when he received 1/8/2013. So you directly deduct out of cost of acquisition. So cost of acquisition as per the working note number 1, 2,25,000 minus advance money forfeited 25 and balance 2 lakh rupees we called a net cost of acquisition. Okay. So now we are going to work out the problem. See, and write down the heading like computation of long-term capital gain for the previous year 22-23. You make divide 3 columns, the particulars, amount, and start with the sale price given 8,60,000 and less selling expenses given 10,000 rupees, and deduct what is the balance. The balance we called 8,50,000 called a net consideration, followed by this cost of index. So already you know the cost of index is nothing but finding the present value of past investment. So cost of index is applicable only in long term. Okay. Index cost of acquisition, and we write down the formula like cost of acquisition or fair market value into CII for the previous year divided by CII of the year of purchase or fair market value. Okay. And you know the value. So working note 1, with help of working note 2,25,000 we find the value, and followed by the working note 2, advance money forfeited we deducted out of cost of acquisition 25, the balance we called 2 lakhs. So 2 lakhs into 331, that is the CII for previous year divided by the base year of 2001 and 2200, and value 6,62,000. Index cost of improvement, there is a formula cost of improvement into CII year of CII for the previous year divided by CII for year of improvement. So 60,000 into 331 and divided by 113. So what is the value? 1,75,752, and what is the total? 8,37,752. You deduct out of net consideration. So balance 12,248. Balance 12,248. It's a long-term capital gain. And followed by less deduction or exemption under section 54, a reinvestment of capital assets. So here there is no reinvestment of capital assets. So put outer column nil, the balance we called as a taxable income from long-term capital gain 12,248. It's simple. Now we are in the end of today's session. I hope you are very much confident about the calculation of capital gain. Stay connected, watch my regular videos.